So today our unit is 16 and 15. Topic name is strategic planning and budgeting concepts, and the other unit is for the budgeting. Broadly, we are going to discuss two theoretical concepts. One is strategic management and strategic planning. Then what are the budget concept, how it helps the organization, how it creates motivation, it increases the performance. Then what are the budget methodologies, how we prepare the budgets, and then two broad classification in terms of operating budgets, which will include your all operations like AP, AR, account receivable, account payable, IC inventory control. Strategic word when we use this is for the long term. Strategic planning and budgeting includes setting the direction of the company. Suppose you are based in US, now your company operation has increased and people all over the world is giving you inquiries and you are feeling that you should come out of US and you should make your office in Europe, in Middle East, or you have to cover the African market also. For that you have to take the strategic decisions based on your vision of the management, top management, owners, board of directors. That how they want to place themselves. Are they going to place themselves as a quality producer, the market leaders, cost efficiency providers? What is their vision to develop their company? Because everyone makes money out of their operating activities. Someone is more cultured oriented, some is more customer friendly organization, some don't care for the customer services but still they make money. So it all depends upon the strategic vision of a company, that how they place themselves in a company, in the world, positioning. And surely you should know your strength, weaknesses, opportunities and threats. That is a typical SWOT analysis that we do for all works. For example, if as a CPA candidate you want to do your SWOT analysis, you will see your strength. That what is your strength? You are ready, you are a quick learner, or you are a sharp learner, or you have ability to study. This you consider as your threat, as your strength. Weakness, you might be feeling something that maybe 2 years, 3 years down the road, 5 years, you are out of education. So it will be a little, problem for me how I will study. This is internal weaknesses someone is thinking about. Now, the strengths, weaknesses, opportunity. If you develop yourself if you are managed to do CPA, the life is different. Exposure is different, knowledge is different, behavior is different, personality is going to change, and job perspective is going to change. And what are the threats? Threats is if you don't have a professional qualification, might be if you lose your job, you will not get a new job. And if you are having one qualification, but that qualification is not equivalent to CPA, then again it's a threat. But opportunities are there in the market that if you do this, your career change, everything is going to shift because it's a reputed degree. So same way for the companies, they have SWOT analysis. Suppose you are based in US, you want to come in Middle East. The first thing is your strength is you are a big company, you have big finance, you are not worried about sustenance, and your market name is already established, people know you. This is your strength. In fact, people are calling you for to come in this region. Example is CPA itself. That CPA has never been outside US, but all the people going to US to get the examination. So their positioning, branding, imaging is in a way that all the world is asking for to come outside of US. Same way, if you are Nestle, if you are McDonald's, you are KFC, you are Burger King, you are Procter & Gamble, you are any FMCG company, people know you. They want you to come. This is your strength. And sometimes local manufacturers are feared from you. Because you are a big company, people know you more than their own brand. They want to have a made in US product, they want to have something which is more reputed. So once you go in that country, the local manufacturer will create a problem for you. Might be you will get problem in terms of availability of raw material, then in terms of labor, unions issues might come. So these are all the threats that you have to see. And but opportunities are there because you are having a large economies of scale, your size, your financial economies, your technical economies, and your economies in terms of human resource efficiency, training and development is very high. So it will be a great success. It will be a learning for the market if cultured and high-tech technology you bring into a small region where they are not used to. It will be learning for that part of the world as well. So these things we have to keep in mind. So for expansion, you have a separate budget. For a contraction, you have a separate budget. Suppose we are based in US, we have Middle East operation. Now we want to make a factory in African countries. Say Burkina Faso, we identify which labor is cheap, land is cheap, we will go there. Now you need to spare more finances, so it will lead to a capital budgeting, long-term, long-term purchase, asset, equipment, IRR and PV calculations will be there. This is for long-term assets, long-life assets. Then you should have a human resource budget as well, because this human resource is going to add value in your business operations. Now, this budgeting is going to change the whole life of the organization. If you are in the expansion mode, then you need more finance, your capital asset pricing models, then your IRR and PVs. Then supported to this, you have human resource budgeting. You need more employees. Then you need more technology, more infrastructure. So altogether, it's going to change the operational part of the management. That's why when your board is seeking for a new business, and when they call the CFO or the CEO, the first question should be that what they want to achieve, means what is their plan, how they want to. If you are a company based in US, you want to come out of US, then the first question is which area and what type of customers, what kind of vision that you have in the market. That will be discussed in the strategic management. Strategic planning, for this we have some tools, some theories like SWOT analysis, strengths, weaknesses, opportunities. Portal models are there. Budgeting concept, then will come what is a budget. Budget is also called as a profit plan. Budget can be loss. You can budget the loss for 2 years and then 3 years, 5 years, it's up to you. Budget does not mean that it should be always a profitable budget. This should be a multiple choice question. You will see the CPA past examination that budget should be always a profit oriented. No, it could be 2 year, 3 year, 5 years loss as well. Depend upon the life of the project. If it is 20 years, first 4 year, 5 year is the seeding, research and development, and you are making your products, it's under development, something like that. 5 year it will be loss. Then it will be, but this is true that every budget should have a break-even budget, that whatever you invest, you have recovered. And above that, you should have other things. Otherwise, your directors will never convince on your feasibility that you are spending some money from them, and it's always 5 years project is lost. So they are losing money, no one will go for it. For that, we have to learn the IRR and PV concept that we will discuss in today's lecture. Budgeting we divide into 2 sections. All organization, either it's a bank, it's a FMCG, any big companies, we have to divide into budgets part. One is the operational budgeting, one is the financial budgets. And financial budgets will start when the operational budgets will finish. This is the condition, that you cannot make a cash flow when you don't know what is your purchase, what is your outflow, and you don't know what is the sale, what is your inflow, right? So operational budget is a budget which defines and confines the operation of a company into a master budget. This master budget will be giving you the sales budget. All budgets will start, the first thing is the objective, of course, but in terms of technical knowledge, it should start from the sales. Sales budgets will be the first point to make the operational budget. This kind of multiple choice question you will feel in the exams, that he want to check what is the source of the operational budgeting. Surely this should be the sales. Sales will tell you how much unit they need, then it will go to a production budget or a purchase budget, then direct material, direct labor, overheads budgets. This will be a connection. Based on that, you will make your cost of goods sold budgets, and you will be able to make a pro forma income statement budget. That is a standard PET format, income and expenses, and you will be in a better position to see that what is the operating income or operating loss you are going to have. This is the bottom line of the operational budget. Now you will start your cash budget. Then based on your units production or the sale forecast or the production requirements, you have to buy the fixed assets. Then you will make a capital budget, that is showing your machine, equipments, what is the useful life, and you will apply certain models on that one, that is capital asset pricing models. You will calculate beta. All these all in technical information we will discuss today. And then you have to make the cash flows, inflows, outflows are there. And in the last you will make a projected or a budgeted statement of financial position, which will show your assets, liability and capital, typically a balance sheet. Now I'll start the discussion. Strategic management is always having a long-term objectives, long-term vision, direction of the company. This is generally settled by the board of directors. It sets your strategic vision. Now, for setting that, we need to develop a mission statement. We should have overall objectives, goals. Then we should have a long-term strategy, and when we will make the operational budgets, we will make a short-term strategy. For this, a grand strategy is SWOT analysis. That is your strengths, weaknesses, opportunities and threats. This is I already explained you. If you are a company in US, you want to come in Europe, Middle East or Africa, you have opportunities that your goods will be saleable, you are reputed, people know you before. You have high acceptancy in terms of the sales. But and you have opportunity because your technology is new, you have your product is powerful, quality, and you are considered as a market leader, so opportunities are there for you. Threats are, if someone don't like that area you are going, you have political threats. Now, when you have, every management has 5 components as minimum. What is management? Management is a process of planning, organizing, designing, implementing and evaluation. This process is called management. If you are doing financial management, means you are planning finances, organizing, coordinating, designing, implementing and evaluating the finances. So this will be a financial management. Same way, if it is a strategic management, you are planning the strategic vision of the company, then you will organize information that if we want to be a company working 160 countries, so what should be the information required to us? This is in organization phase you will do. Then after your research you will make a model, that is your design. That this country, this place, this much employees, and this is our model. You will implement that one. After implementation, you will evaluate every year, every quarter based on your needs, that how well you are in your planning. If you are planning what you plan, you achieved, then you are in effective strategic management. Otherwise, you have to complete the cycle again. Plan, reorganize, coordinate.